crypto world, the fundamentals are very, very different. The two primary areas are the technology of the crypto, how robust is that technology, how sustainable is it, and the adoption of the crypto. And those two are both equally important factors. Perhaps the adoption is even more important because you could have the very best technology since sliced bread, but if it's not popular and people aren't using it, then that crypto could die a premature death.
If you're gonna get in crypto, you gotta have passion and you gotta have conviction. If you don't have those two things to where you believe in blockchain technology, then I would tell you not to invest in it at all, because you're gonna sell at the wrong time and you're gonna lose all your money. But if you understand that in 100 years from now, there's a 0% chance we're gonna be trading pieces of paper and pieces of metal and it's shaped in a circle to do business, and you understand everything is going digital, then you know what's coming. You understand that's the future. There's no way 100 years from now, we're trading paper.
Hello and welcome to episode 1 of Money 2022. I'm Dr. Patrick Gentempo, and I'm very much looking forward to taking this journey with you. The world is in a very unique and threatening predicament. What are we seeing right now? Inflation on the rise in ways that nobody could have expected. We're seeing the so-called pain at the pump, gas prices that are high. We're seeing political upheavals in so many different places. Russia invading Ukraine. And that's disrupting the world in an extraordinary way, both economically and in other ways. Then we see the threat of China, and so many people are concerned. What's China going to do right now? And nobody is really sure. COVID, completely disrupting the world in so many different ways. We felt like that it was fading away, and now they're talking about potential new variants that are coming and shutdowns that will occur again, etc. This is a really disturbing, uncertain time. And what we need to do in uncertain times is find a path to certainty. What can we do to securitize our future? And as crazy as this might sound, could there be opportunities for us in this to actually create a better future for ourselves? So what did we do? We sat down with the greatest minds and experts in the world that we could find and talked to them about this. And I will tell you that I'm startled by what we did find. Our experts have a variety of perspectives on this, but pretty much all of them agree that, number one, it's not business as usual, and it's not going to be maybe ever again. Number two, that there's certainly a threat to people of varying socioeconomic strata, and that there is opportunity to transform this and to create a new path forward for us. But the key is to have the right information and to act upon it, and the timing is also critical, which is why you want to learn this stuff right now. So Money 2022 is a very ambitious project, and it's an extremely critical experience for you to get the information you need, and I'm excited to take this journey with you. I really hope that you'll not only watch this series, but you will pay attention and take some notes and take some action on it. And what I want to ask you right now, as we're just starting our free viewing period, is to share this with other people. And if there was ever a time for you to step up and share something with people that you know, love, or care about, now is that time. Again, we're in the free viewing period. They can register and watch it for free also. And let's all benefit from what we're going to learn through this experience and make sure that we safeguard the future for ourselves and other people that we care about. So thanks for being here. Let's jump into episode 1. Rating assets is something that's important. How do you rate them? How do you know what you should invest in, shouldn't invest in, etc.? Well, there are companies that do this. There's companies that actually rate these different assets, different funds, different equities, et cetera. And Martin Weiss is somebody who does exactly that. He is the founder of Weiss Ratings. And his firm is the only firm right now that is rating cryptocurrencies. So when you are looking to get insight to understand where to place your bets, what kind of investments to make, knowing what the ratings are on these investments is probably a smart thing to do, and we're going to learn more about that right now. Enjoy this interview. Dr. Weiss, thanks so much for taking the time to be here with us today.
You can call me Martin.
Okay.
And thank you very much for inviting me.
So you've got an interesting background, and the work that you do, I guess over some decades now, is something that I think people need to understand and pay attention to. So can you kind of get into your background and how you got to be doing what you're doing today?
Sure. We started in 1971, which is over 50 years ago. And the purpose was to issue ratings on individual companies, banks, financial institutions, because even back then, I looked at the ratings that were being issued by Moody's, S&P, Fitch, at that time Duff & Phelps, AM Best, and I realized that there was a serious conflict of interest embedded in their business model, whereby they get paid very high fees per rating, per subsidiary, per year, which gradually grew to like $50,000, $100,000 each. And so effectively, the ratings are bought and paid for by the rated companies.
Right.
And that's a serious conflict of interest, which later came to the fore, especially in the Great Debt crisis. A lot of people lost a lot of money following those ratings. So ever since we began, we've established a policy whereby we never accept a dime for the ratings from the rated companies. Our sole source of revenues is from the end user, the individual investor or consumer. And so by doing so, we've eliminated any possible conflicts of interest. We have no business whatsoever with those companies, not even advertising business.
So can you explain what a rating is?
A rating is, regardless of the entity or investment, it's on a scale from A+ at the top to E- at the bottom. And anything between everything B- or better is green, or a buy rating. Anything in the C range is hold or avoid, basically a fair rating. And anything D+ or lower, from D+ to E-, is effectively a sell rating.
Right.
We issue these ratings on a wide range of entities and investments, starting first with banks in the 1970s, when banks were at high risk. Then moving on to credit unions and other financial institutions, insurance companies. And then more recently, in 2000, we began issuing ratings on stocks. And with the same rating scale, but obviously there's a different kind of rating.
Sure.
And in our very first issuance of ratings, back in early 2000, we looked at the field, and among all the stocks that were listed on the NASDAQ, especially the .com and technology stocks, not a single one got an A rating.
Wow.
In fact, the overwhelming majority were sells. At the same time, Wall Street was not issuing any sell ratings. The worst kind of rating they would issue was a hold rating for all those same stocks. And sure enough, that was at the very peak of the .com boom and the very beginning of the .com bust. And not only did it bring down the .coms, but it brought down the entire NASDAQ to the tune of 75% losses on average.
Wow.
And so it wasn't until the market started really recovering, both fundamentally and technically, in early 2000, in mid-2003 into 2004, that we first upgraded those companies to a buy. And for many of them, we haven't issued a sell ever since. So for Apple and for some of the major companies, the total returns that an investor could have made just following those ratings are in excess of 20,000%.
Wow. So is there a difference between when you're doing a rating on a company like Apple and an analyst on Wall Street is doing a rating on Apple? It's essentially the same category of thing, although you obviously might have differing opinions, or is it something that's different?
There are two kinds of stock ratings in the world today. There are ratings that are either connected to or driven by the investment banking business. Mm-hmm. And those are not objective ratings. They're just subject to serious bias, either because of the analyst himself or because of just the process. Mm-hmm. And there are independent ratings, independent firms that do not have that serious conflict of interest involved in the process, which tend to be more accurate. So in the field of stock ratings, we're not the only ones issuing independent ratings, but in other fields we are.
And if my research is correct, you've started rating crypto?
Correct. So in 2017, before the market really took off in that final hyperbolic phase of the bull market, we looked at the crypto world and said, oh my gosh, this looks worse than what happened in the dot-com bubble. Not only is there a lot of misinformation, but there's no hard research. 90% of the buying and selling was driven by rumor, by chat groups on the internet, people just hyping up their pet projects. And it was very hard at that time to find any serious research. So we looked at it and said, look, this is the time for really hard-nosed, objective research on the industry, and for the very first time, ratings by a financial rating agency. At that time, there was no such thing. Yeah. You could not look up a crypto and find out what the rating is. And so we developed a model. I looked all over the world for someone who had the ability to develop that kind of a model and knew cryptocurrencies. So fortunately, after a long search, we found a gentleman in Uruguay who has a degree in econometrics, which is excellent for building predictive models, and also was a cryptocurrency expert and trader. His name is Juan Villaverde, and he is the primary architect of our crypto ratings model.
Wow, I think there's got to be some sobriety injected into the whole crypto thing for sure. And there's the mania that's there, but then and you personally, I've been the beneficiary of that to some degree. And on the other side, though, I'm sitting there trying to understand what the true support is under all this stuff that I own. And
right.
I find sometimes that through the methodologies that you described, can see arguments for what the rationale is, and then at other times I sit there and say, I'm feeling a little exposed. So I'm looking forward to that conversation. But I want to make a point, because you said something earlier, and I think this goes to the importance of ratings and also the malfeasance or the improprieties that are baked into how ratings have worked on Wall Street, and that's going back to 2008, where all this paper that was bad paper got good ratings, and then that's kind of when how can I put it? It came out from the dark into the light to say these rating agencies are rating all this stuff and they're giving it high marks, but the people that they're giving the high marks to are the ones who are paying them. How do we allow this to happen? And so given the way the system was structured, not the way you do it, but the way that it's done kind of in the club on Wall Street, it seems like 2008 was an inevitability. It had to happen at some point because of the conflict of interest. Is that a fair statement?
I think 2008 was driven by many other causes, and that enhanced. In every cycle, you have some factor that enhances it, that's driven by market hype or the ratings or the analysts. The analysts also got carried away in the late 1990s with the dot-com bubble. They were giving buy ratings, high buy ratings, all on Wall Street unanimously to companies that had no value, like you said, no support under them, just a lot of investor mania. So it's not unusual for analysts themselves, supposedly objective analysts, to get carried away by the euphoria.
So can you give us, and I know it's probably extraordinarily complex, but can you give us maybe just a sense of the type of analysis you have to do to come up with a rating for cryptos or for equities? Are they much different from one thing versus another?
Well, there are some things in common, but the crypto and equities are very, very different for most of the fundamentals.
Yeah.
In the case of equities, the fundamentals are driven by the traditional asset metrics, such as profit and loss, sustainability of the dividends, balance sheet factors. Those are the key fundamentals. In the crypto world, the fundamentals are very, very different. The two primary areas are the technology of the crypto, how robust is that technology, how sustainable is it, and the adoption of the crypto. And those two are both equally important factors.
Okay.
Perhaps adoption is even more important, because you could have the very best technologies in sliced bread, but if it's not popular and people aren't using it, it's not getting adoption, then that crypto could die a premature death. We look at both, and that gives us what we call our tech adoption index. And then, on top of that, we have a risk-reward model, which we call our market performance index. And there, in the risk-reward side of things, based on market forces, market prices, pretty much the same kind of analysis works both for digital assets and for traditional assets. Because everything it's just price movement and price momentum.
Right.
Now, the formulas are different because cryptocurrencies are so much more volatile. But the idea is that you want to find an investment that has good uptrend without big drawdowns, without big collapses. And that's what leads to a high grade in the risk-reward model. So to repeat, you have fundamentals and you have technicals,
Yes.
right?
Yep.
And the technicals are pretty much similar in both types of assets, but the fundamentals on the equity side is more driven by earning statements, balance sheets, and other data we can glean from that. Whereas on the crypto side, it's driven by the crypto technology and the crypto adoption.
Is there a relative grading in the sense of, you mentioned the volatility of crypto, for example. It's like, okay, so I would have to imagine with the volatility and how things change so quickly that maybe you have to update those ratings more frequently than you do on other more traditional types of things that you rate, or no?
No, we update everything daily.
Okay, everything gets updated daily, okay.
Yes, in terms of the market prices, we have daily pricing, right?
Right.
So that gives us the opportunity to update it daily. On the fundamentals, we can't update it that
Right.
frequently, but it's also very frequent, yeah.
Wow, yeah, that's interesting. And then, given its volatility, in other words, an A-rated crypto versus an A-rated equity stock, it's like,
It can
is
be
it
more
sort of
volatile.
like curved, meaning, well, for a crypto, it's an A, but if we had these types of parameters in the equities market, it wouldn't be an A. Is that kind of the way it looks?
The formulas I said earlier are different.
Yeah.
The concepts and the principles are the same, but the formulas are different because they're totally different asset classes.
Yeah.
And yes, it's possible that an A or a B plus crypto, right, in terms of its volatility, would be relatively more volatile than a B plus stock.
Yeah.
That is
Okay.
possible. But that's not rating them on a curve per se. It's developing different formulas that are more suitable to each asset class. I don't think the folks in the crypto universe would appreciate the idea of applying stock market formulas to cryptocurrencies, and for good reason.
Yeah. I love the work you do because of the significant amount of objectivity in it and the lack of emotion in it. And I think it's important for people to have that perspective and that context. And obviously, since your firm has been doing it for over 50 years, it must mean you're pretty good at it, because you wouldn't have lasted this long if you weren't really good at it. And I love also the fact that you've been able to see a lot of things happen over all these years. Because from 71, I mean, you went through the whole Carter era. You saw a lot of, inflationary dynamics and all these other things that are going on.
The day we started,
Yeah.
was just around the time we started is when President Nixon devalued the dollar by releasing the gold standard, August 15th, 1971. Mm-hmm.
Yeah, so you got to see a lot. Here we are in this world now. And you could answer this question probably better than anybody I know, as far as how you're interpreting it. But between, the inflation we're seeing, this enormous amount of money that we're printing, looking at the COVID shutdowns and that whole thing and what that did and the reverberations of that we might not even know about yet. Supply chain issues. Then we have Russia invading Ukraine and that whole thing. There seems to be many things happening all at one time. What's the impact on this, on your thinking about the varying aspects of the varying asset classes? Are we in bubbles in them, or should we have concern? Should we be very guarded right now? Are things overvalued? How do you see it?
Well, you explained it very well there. Let me rephrase it. We are witnessing a convergence of cycles and a convergence of black swan events that are the offshoot of those cycles. We think of black swan events as unpredictable, something that just hits out of the blue and totally unexpectedly. But we're in a time and place where we now have to start expecting those black swans. We don't know exactly what they will be and where they will strike, but we do need to be ready for them, because the financial system, the way it's been abused and weaponized and twisted upside down, makes all of us, both personally and financially and in every different aspect, it makes us more vulnerable to those kinds of black swan events than we might have been in the past. So this argues for caution, and argues for new kinds of solutions that may not have existed before. And that's possibly leading us down a path of what I would call positive news. And the positive news is that there are going to be, or maybe there already are, some very constructive solutions to the crazy mistakes we've made in the past, in recent years. You mentioned a couple of those crazy mistakes. One was the, crazy, unprecedented printing of unbacked money, of paper money. Just since the emergence of Bitcoin, you're getting close to $8 trillion of new money that's been pumped into the U.S. economy, not including what the European Central Bank did, what the Bank of Japan did, what the Bank of England did, just the U.S. Federal Reserve. And so we're going to have to pay the price for that. And it's not the politicians who are going to have to pay the price. They'll be gone no matter what. Yeah. It's us, the average people, investors in the United States and all over the world, that are going to have to pay the price. Now, here's the good news that I would like to lead to. In the past, there was no other alternative. It was the US dollar and other major currencies and the existing traditional financial system. And the only way that the Fed and other central banks were able to cope with the crisis is just to add more of the same, pump in more money. And as we all know, they didn't solve the problem. They just swept it under the rug and kicked the can down the road, making it worse and worse and worse with each cycle. They had no other alternative. There's no other place to go. as far as they were concerned, that was the only way for them to save the system,
Right.
even though they were actually undermining and destroying it as they said it. Looking ahead, with the emergence of cryptocurrencies and everything that it spawned off, we now do have an alternative. And I'm not talking just about Bitcoin. Actually, I'm talking mostly about decentralized finance, or DeFi. With decentralized finance, we can see the light at the end of the tunnel, and that light is an entirely new, more secure, more efficient, more democratic, and more stable, sustainable financial system that's not controlled by any central authority, and therefore has no single point of failure, but rather is totally decentralized and controlled by millions of actors, each acting in their own best interest. Finally, the democratization of money. And finally, a kind of money that cannot be weaponized, as is being weaponized today, for example, in the wake of the Russian invasion of the Ukraine. Not that I disagree with those policies. I'm taking a neutral stance about the policy, but the very fact that a country, even a benevolent country, even a country that we support, is using money as a weapon, opens the door to other future empires and countries to also use money as a weapon. And as they do that, it merely defeats the whole purpose of money and opens the door to an alternative system like decentralized finance that's based on blockchain. So that's very positive.
Yes.
And what it means is maybe the next time around, the central banks won't have to just print money like crazy to sweep the problems under the rug and kick the can into the future. Maybe the next time they'll be able to say, hey, wait a minute, there's actually an alternative solution here. Is there a way we can bring our traditional financial system and this new modern financial system together, or make some significant revolutionary shifts in order to find a true sustainable solution, and maybe we don't have to go printing money like crazy again?
But Martin, let me ask you this, and I'm heartened by what you just said. Are the governments going to allow us to walk away from their system that they completely screwed up and get into DeFi, or are they going to try to somehow take control, regulate, inhibit, or has the horse left the barn? I'll use all these metaphors. They can't put the genie back in the bottle, what have you. Where
Right.
do you think we are relative to that?
The horse definitely has started to leave the barn, and the only way they could shut it down is by shutting down the internet entirely. So in that broad sense, the horse has left the barn. There's been a lot of debate in some of the most highest levels of government and among the most advanced thinkers and movers and shakers in the crypto world. And the debate is seeking to address your very question. Is it going to be a battle, a millennial battle between those who control traditional finance or regulate traditional finance and those who are seeking to build this alternate solution? Or is there going to be some sort of a compromise and a peace and a coming together? Well, no one can predict how that's going to unfold. It may be a combination of both, depending at what point in the cycle we're in. But if you look at history, going back thousands of years, you'll see that typically it's a yin-yang type pattern. Good comes out of bad. Too much, and it moves in a cycle which, for the very long term, is an evolutionary cycle, where the systems are improved and are brought up to the next level. And that's what I think is most likely in this case. Out of crisis, out of desperation, out of utter frustration, everyone, including those who control the old system or who have benefited from the old system, comes together and starts rebuilding with the new. Until that crisis, until you have that level of desperation, no, then it's a competition, it's a battle, each one trying to defend their own turf.
So there's going to be, I guess, between point A and point B, where we are, and then this new world maybe that emerges, that's the positive thing. There could be a whole lot of pain in between the two, an upheaval, I'd imagine. And right now, another thing that actually maybe is the most disturbing thing, at least for me, that I'm observing, is the wealth gap. Because that's the implications of how that wealth gap is starting to widen.
Yes.
That the gap, that basically, rather than a bell curve of a middle class, it's almost getting inverted, where it's either very wealthy or not much at all.
Yes.
And
there's very good data to support that.
Yeah, and that's a threat. I see. As these things are going on, so. Given that there's, let's just call it disruption that's coming before we maybe evolve into a better universe of economics, in humanity.
Disruptions
let me ask,
are normal.
Yeah.
They don't feel normal while you're in the midst of them.
Yeah.
But if you look at it from the broad perspective of history, they're normal, to be expected, and they're not all bad.
No.
Good things come out of them.
Yes. So, but anticipating that, and as you said, which I thought was your first person I've heard say this, we're looking at, multiple black swans that are starting to appear, as potential things that happen. So now, if you're somebody saying, on the individual basis, say, okay, I have to become self-responsible for my finances. Nobody's coming to save me. Given everything that we just discussed, what do I do? Because if I say, you know what, there's a lot of threats, I'll stay in cash, but cash is losing its value every single day. Okay, well then maybe I should start to invest in certain things to hedge against that inflation. What kind of recommendations would you have for people based on the conversation we've been having to say, in the short term at least, if not, for let's say next 2 to 4 years, here's the kind of things you should be doing to either safeguard or grow your wealth?
The first thing to do in this era of rising inflation is to find a way to earn higher yields, much higher yields, without taking the downside price risk that you normally associate with higher yields. In other words, what you want is to protect your principal from market fluctuations, from market volatility, and at the same time achieve yields that are as high as inflation, or ideally much higher than inflation. You want strong principal and high interest. And if you look around the traditional financial world today, that's absolutely impossible. If you want to protect your principal, for example, with a bank CD, the very best deal you can get in a U.S. bank today is a 5-year jumbo CD, which means two things. Number one, you have to lock up your money for 5 years or you're going to get serious penalties for early withdrawal, right? Number two, it's jumbo, so you have to put up at least $100,000. And even if you meet those two requirements, guess what you get?
What?
A meager 0.25%. If interest rates go up with the Fed, rate hikes, maybe you'll get 1% if you're lucky.
Right. Jeez.
And that's the average in the U.S. today for the very best deal you can get. Wow. So with inflation running above 8% and maybe headed much higher, that means even if you could make the 1% that the Fed hopefully will give you over the next year or so, you're still losing 7% per year on your cash.
Wow.
That's a disaster.
Yeah.
It's a disaster because not only because you're losing money, but because it drives millions of investors to take excess risk chasing higher yields or higher returns with junk bonds or with stocks that they hope to get some dividend yield on. And that excess risk does what? It makes you more vulnerable to these black swans.
Yeah, right.
That's not exactly a good path to follow, right?
Right.
So decentralized finance not only may be a solution for the financial system in the future, especially when it gets into trouble, but it's also a solution for you, the individual investor, right now. The demand for borrowing money in the crypto world. Obviously, it's going to depend on how much transactions are going on, how much people want to borrow money for the sake of buying cryptocurrencies, and just a whole series of factors that help build up that yield.
Yeah.
This is why. And finally, there's another big factor, and that is when you're in decentralized finance, for the most part, you're not paying for the rich lifestyle of bankers. You're not paying the big salaries of all their staff. You're not paying for all their investment in rent and equipment and plush offices. And essentially, you're not paying for a middleman, the bank, the institution. And so that's another huge benefit. How much of your yield that you should be getting from the bank is going into the bank's profits, is going into all the expenses and operational costs that they incur? Quite a bit.
You know, that last thing you said is profound. And that's the whole point of DeFi, right? Is that to remove all that. But when you start to look at the buildings on Wall Street, the bankers' lavish lifestyles, et cetera. And I'm starting to realize, wow, if that's all baked into what they can afford to pay as far as interest on money, and you take that, you put that all back in, because because one of the things I thought about saying, okay, they're taking this money and they're lending it and they're getting return, and that's how they're distributing the in DeFi these interest rates. And then I'm saying, but I don't know how good the vetting process is for who they're lending to, and what happens if they don't get paid back. But I just haven't been deep enough into the rabbit hole to understand those things.
Well, that's the beauty of DeFi as well, because it's algorithmic, and because it's instantaneous.
Yeah.
And the reason that's so important regarding risk is because anyone whose collateral falls below the minimum is instantly liquidated. And typically, this may change in the future, but right now, the norm is for all lending to be over collateralized. And this collateral, you don't have to wait until some auditor comes in or some to value the property. And by that time, the property has already fallen in value. The collateral on your loan has already fallen in value. No, this is happening instantly with all the massive data feeds and the algorithm. And there's no time to wait.
This might not be the right term, but the concept would be right. So if there's a sudden crash in the crypto market, because I guess it's collateralized by their crypto holdings, right? Are there suddenly margin calls all over the place that just pull all the money back, or what happens?
It's liquidated sooner than that.
Yeah. Wow.
Because it's over collateralized. If there's a black swan event and Bitcoin falls 10-20%, it's gone. It's faster than that.
So it's starting to sound like a perfect economic system.
It's not perfect. To really stress test any system, right? You have to see what would happen, for example, if a third world war shuts down the internet in most of the world.
Well, if that happens, we got other problems.
Yeah, I know that. Yeah. But that's an extreme example.
Yeah.
Okay. So the fact that there's no central point of control, a central point of failure, or a central point of control is what really maximizes the sustainability of it. But nothing is perfect.
Yep.
Instead of buying and holding Bitcoin, or in addition, I should say, to buying and holding Bitcoin, we've picked out a half a dozen leading cryptocurrencies, which can help you diversify your crypto portfolio. And if you go to our website, weissratings.com, you'll see multiple sectors that we're covering: stocks, banks, insurance, and so forth. And you'll also see crypto. Go to the crypto page and click on ratings. You'll immediately get a list of all the ratings we cover, and you can sort from best to worst, or from worst to best if you want to look for the ones to avoid. You can also click on a little icon that looks like a funnel, and that is the filter tool, which allows you to select various parameters so you can narrow the list down to your needs.
Yeah, got it. I, for one, will be going there pretty quickly. But let me ask this question. So other than Bitcoin and Ethereum, which of course everybody knows and are the two most popular, Is there one that you particularly like?
Well, if you go to the website today and you follow those steps I just mentioned, and on top of that, if you would restrict it to those with 1 billion or more in market cap,
Yep.
and you'll see right at the top, you'll see the cryptos that today are right next to or up there with Bitcoin and Ethereum.
Yep.
This will change, and the ratings are updated every day. I would not say, oh, just pick one.
Yeah.
I would recommend that you diversify your portfolio among, say, 5 of those top-rated cryptos. That's step 2. So step 1 was for your cash.
Yeah.
Step 2 is a diversification of the portfolio. There's a step 3 also.
And just
which
one more question on step 2 before step 3. And
Sure.
this is so good, I can't even tell you. It's really, I'm loving the way that you're approaching this. But on step 2, is this a buy and hold type of a thing? Like you're just talking about saying, diversify and buy and hold, or
Right.
are you recommending that you should be trading this in time?
Well, we just anticipated step 3.
Okay, good. Okay, well, so 2 is the buy and hold. Step 3, now let's go.
So step 2, let's finish. Let me answer your step 2 question this way. Yes, you could buy and hold. And if you buy and hold, you just have to close your eyes to the extremes. Close your eyes to the declines, even no matter how sharp they may be, just hold.
Yeah.
But also close your eyes to the big peaks, which means don't rush in to buy more. Just hold,
Okay.
all right?
Yes, I'm with you.
The step 3 is something that is very important, but could be trickier.
Okay.
And that is trying to time your buys. Trying to buy at a time when you can get better prices and sell at a time when you can get better prices for your cryptos. And that can be very tricky. It can be very emotional. So we generally don't stress that for the average investor. But if you want to take a deeper interest and a deeper dive into the cryptocurrency world, then we do provide services that can help you with the timing that are based on an entirely different kind of analysis than we do for the selection analysis.
Yeah.
So it's selection and timing,
Yeah.
right? The ratings, our Weiss crypto ratings model is designed for better selection. For better timing, we have a crypto timing model. And it's based on a fundamental aspect of nature that we alluded to at the beginning of this conversation. Cycles.
Yeah.
The cycles of markets, the cycles of evolution, the cycles of history. And they, as we mentioned also before, they're converging in this period that we're living through. And we're seeing signs of that convergence in the form of black swans and other trends that are kind of disturbing and shocking.
Yeah.
So if you look at Bitcoin, even though it has a relatively short history, it does have a pretty regular cycle. Some people think that that cycle is revolving around or driven by the halving cycle,
Yes.
where every 3.5, 4 years or so, the quantity of the
same effort gives you half as much Bitcoin. Yeah.
Correct, exactly. Thank you for putting it that way. But we don't know if the halving cycle is the primary driver. It could be one of the drivers. The fact remains that Bitcoin has followed a cycle, despite all its volatility, that is more regular than some of the cycles we see in other asset classes, like stocks or bonds. And one of the reasons may be because it's not manipulated by, centralized organizations like central banks or ministries of finance.
Right.
And so that cycle can help you time the market to such an extent that we've developed a whole new computer model that is driven primarily by the Bitcoin cycle and the cycle of the whole cryptoverse. Its duration is about 4 years, a little bit less than 4 years. Within that let's say, 320-day cycle, there are 4 80-day cycles. And within each 80-day cycle, there are 4 20-day cycles. Now, these metrics I'm giving you, 320, 80, and 20, are averages because the duration of the cycle varies.
Yeah. Understood.
It's not like a automatic every 20 days.
Right.
But despite that variation, we find it's very, very helpful in timing the market.
Wow. Yeah. Well, I think so. I love these 3 approaches. So, can I ask a recommendation? If I have a certain amount of liquidity that I'm going to put into these 3, what would be the ratio? How much into a stable coin versus how much into hodling, buying and holding, and how much into the timing?
Obviously, that is your decision depending on your risk profile.
Okay.
If you're an investor, you want to go beyond saving and earning yields to investing, then you could go as far as step 2 and say, okay, for some portion of my money that I can afford to risk, whether it's 20% or 10% or whatever it may be, I'm going to buy and hold these 5 best cryptocurrencies, and I'm going to not worry about it. Let it ride. I'm not talking about jumping in and out and trading like crazy.
Right.
I'm talking about a very modest, deliberate way of waiting for the market to go down before buying. Be patient. Don't try and chase the hype. Don't try and chase the booms. There's always going to be corrections, and sometimes those corrections can be pretty severe, and that's the best time to buy.
Great.
And the last point is when you get those corrections, you don't have to throw all your money at it. You can periodically buy, accumulate. When there's a drop, you accumulate some more.
What's interesting, I'm loving the advice you're giving. What I've been doing is sort of a part of that, but now I realize I have to separate the timing stuff from the stuff I'm holding. Is that if I were to take my crypto account, 2/3 of it I just kind of leave held, and 1/3 I am, if things are rising, I'm selling off, that third, turning it into cash, and then when it drops down, I'm buying back in again, and I'm using about 1/3 of it just to kind of buy and sell on those cycles. But I'm doing it with the exact same cryptos that I hold. I don't like to track more than maybe 4 at a time because then I lose the thread. I like to just get a feel for them. So I've been doing that, but I'm realizing that maybe my buy and holds are different. Because signing up for your service, I'm going to say, oh, maybe I'm going to actually do different crypto that will use the timing, the allocation I have for timing, and trading as compared to what I'm holding. They might be different, or are they typically the same?
I think they could be the same.
Okay.
In as far as step 3 is concerned.
Yes.
We haven't got to step 4, 5, and 6 yet. That really starts getting further out there.
Yeah, well, I think for the purpose of this conversation, we're perfect.
Yeah.
I have one last question here. Turning back down, to the equities markets, because in rating, and you've been rating for a very long time, I'm starting to see, part of it is the price earnings ratio, right? I mean, that's got to be a big part of the rating of a particular company, that's trading in the public markets.
That's one of many. It's one of many.
One of many. But I imagine there's multiple analytic parameters that you utilize in the rating process. Have you had to adjust them, in the recent years, because it just seems like things are, to me, it look, and I'm a nobody as far as.
Now that is rating on a curve.
Yeah, and that's what I'm wondering.
That's what other agencies do, and the best example is in bonds, which is easier to measure because there's a consistent history of bond ratings going back. For example, with Moody's, for I don't know, longer than our history, right? It goes back way back into the last century. So if you compare the balance sheets of those companies and their ratings, their bond ratings over time, you will see that there was tremendous grade inflation. People going to high school and passing the same and getting the same results on a test, but in 1950 they got a C, and today they get an A.
Right.
That's trouble. That's not good. We don't do that.
Okay. And what that means is, as compared to there being, it's a relative grading scale, for all the equities that are there. So the ones that are the best are going to always get an A. You're saying no, they can all fail.
That's right, and that's what happened, for example, in the late 1990s,
Right.
or actually early 2000.
Yep.
All of the tech stocks on NASDAQ on our list were getting bad grades, or at the very best a C grade.
Right.
Whereas on Wall Street, going across multiple research firms, including Goldman Sachs, Merrill Lynch, all the majors, they were unanimously getting buy ratings.
Wow.
Or strong buy ratings right at the top. We don't let that happen, and the distribution of grades will shift over time with the cycle. When you're at the peak of a cycle, typically the valuations, like you said, the price-earning ratio, for example, right,
Yep.
is way too high. It's in the stratosphere, so they get downgraded on our scale. Whereas after a big decline, that particular ratio will be very positive for the rating.
Yes, and I can't tell you how critical I think that is, that you do it that way, because it could be that none of them are worth it. None of them should be bought.
That's right.
As compared to saying, well, we'll just pick the best ones out of the lot, as compared to saying none of them should be picked. Yeah.
When we first issued our ratings in 2000, crypto ratings in January of 2018, there were no A's.
Wow.
Bitcoin got a C+, which I thought was overly overrated.
Wow.
But when the Bitcoin lovers of the world saw our Bitcoin C+ rating, they were pissed. And we suffered a massive cyber attack on our website.
Really? Wow.
Absolutely.
Wow.
They didn't shut us down.
Yeah.
They didn't shut us down.
They tried.
Because we have all our servers on the cloud. We just kept adding servers overnight.
Wow. Wow. Well, what a world you're in. I mean, you couldn't have predicted this in 1971. That's crazy. Well, Martin, I have to tell you, this has been an extremely valuable conversation. You're just a wealth of knowledge, and you have this unique ability to be able to methodically explain things so that they make sense. So I appreciate not only the work that you've done over all these decades, but the fact that you've chosen to come and sit with us and share that wisdom. And I can't enthusiastically enough recommend your service for what you do. I think it's very valuable for people like me who want to invest.
Well, let me share my last secret with you and how I can do this.
Okay.
I'm 75, going on 76, right? But I swim every day, fast.
Yeah, well, and I could tell you that there's the neuroscience behind that kind of activity for your brain being able to function and to stay youthful validates that you're doing something really good. So that's a great secret of your own youth. So thank you for that. I'm glad that you not only have the wisdom of ages, but you have the youth of fitness to be able to bring to the table here. So thanks.
Okay, well, thank you very much for inviting me.
That completes my interview with Martin Weiss. Again, understanding how to rate assets and understanding why people rate them in different ways is important. It's a part of what we have to educate ourselves around when we want to learn how to develop wealth through investment. So I appreciate the fact that he sat for this interview and that you're here right now for it. I hope you got a lot out of it. When my kids know somebody that I'm interviewing, it makes me feel like a proud dad. And Ben Armstrong, also known as BitBoy, is somebody that my kids know about. My kids love studying crypto, and they are on YouTube and other social media platforms learning about it. But when I told them I was interviewing Ben Armstrong, they're like, oh, cool, they know who that was. So anyway, Ben Armstrong, BitBoy, is someone who has a very big personality with a lot of great information, and that's why he is so popular on platforms like YouTube. I'm excited to share him with you right now. Ben, I've watched a lot of what you've been doing on YouTube, and you're very engaging and certainly have some strong views around this whole world of cryptocurrency. So I appreciate you taking the time to have this conversation with me.
Yeah, absolutely. Thanks for having me. Anytime I get to talk crypto, it's time that I love.
Well, then you're going to love this. So, because that's what we're going to talk about. Let's first talk about how you got into doing what you're doing right now. What got you here?
Sure. So it's kind of a long story, but I'll try to summarize it the best way I can. So I've been in the kind of online business world since 2011. In 2011, I created a ticket company where I sold sports tickets and concert tickets and things of that nature, basically event tickets. And something happened in 2012 with a software I used to run that business where they had to start taking Bitcoin. And so I had to buy Bitcoin. I had to learn about it. And it was just this kind of thing where I was like, what is this thing? It felt like some kind of like, kind of sleazy, like gambling dollars or gambling wallet. It felt very similar to that. And so I put the money in, but I was doing it for actually Bitcoin's original purpose was a currency. So I was paying for a service with Bitcoin. Well, about a year later, so I bought in December of 2012. In November, of 2013, the price skyrocketed. And I actually had a little bit of money left over in the account from paying my service fee. And I was like, wow, this is all of a sudden worth a few $1,000s. Like it felt like it was nothing in there, like a couple $100. It's worth $3,000. And so I pulled it out and I was excited to do it. I took my family on a little vacation down to Florida and it was just free money. And I met a guy in a McDonald's over the Wi-Fi to sell him from a site called localbitcoins.com. And as I sat in that McDonald's waiting for him to get there for me to sell those Bitcoin to him, I was researching Bitcoin and it was so hard. I remember seeing it looked like a GeoCity site from like 1995. It was trying to lay out what Bitcoin was and, tell me about this Japanese guy named Satoshi Nakamoto and all this stuff. And I was just really overwhelmed with the information. And we didn't have YouTubers at that time. We didn't have people pushing education on crypto and Bitcoin. So I just kind of said, I sold it. It's over. And in 2017, I had bought Bitcoin a few times over those years. I thought it was kind of over when Mt. Gox crashed in 2014, but it was very resilient. It came back and I bought and sold a few times, but I was never what I would call in crypto really. But in 2017, I started doing the math on how much money I should have based on all the Bitcoin that I bought to pay for that service with. And it was like 8 figures, what it turned into. And I was like, oh my gosh, here I am. I had the best opportunity of my lifetime and I didn't understand it. And so I wasn't able to take advantage of it. And so I decided, even though in 2017, I thought maybe it was too late to get in, I just said, you know what, I'm going to go full tilt. So in January 2018, I started my YouTube channel to educate other people in crypto. And it was kind of a journey for me from an educational standpoint of, as I started the channel, I wasn't that knowledgeable about crypto, to be honest with you. But over the years, being in it every single day, that journey is what has actually led to my vast crypto knowledge and all the research. And so in 2018, in August of that year, I left my previous job and I said, you know what? I'm full-time crypto at this point, making YouTube videos. And then for a couple of years, people weren't really watching. And then, starting in 2020, things really started blowing up for me.
Wow, what a journey. What's interesting is I had a somewhat similar experience in the sense that when Bitcoin first came on the scene, I think when it was maybe around, if not maybe a little bit past when it first came in, but when it was around $300, trading at around $300 or so, I philosophically aligned with a decentralized, non-governmental controlled currency. And I'm somebody who is, I owned and ran for 23 years a technology company. So I'm not tech phobic at all. And I remember I said, I'm going to go and I just want to support this. I don't know if we'll ever do anything, but I'm going to just buy a chunk of it and just show my support for it. And then when I went in to try to figure out how to buy it, the whole idea about the wallets, and at that point in time, it was so complex and so difficult, and as you said, it just seemed so primitive in the way that it was trying to be done, that I said, I don't see that this can really go anywhere. If I'm having a tough time with it, I can't imagine what average people who don't have even my level of tech experience might be going through. So I basically backed away from it, and mistake, obviously in hindsight. And I'm thrilled with what's going on right now. And I'm definitely invested in crypto, but it's interesting how a lot of the early adopters, what it took for them to get in there was something heroic, I think, on some levels.
I agree with that 100%. Like what I'm thinking as I'm listening to you talk is, looking back at my troubles and at your troubles, really we took it as kind of like a sign that this may be too difficult, but in reality, that was the sign of the early adoption.
Yeah.
If you go back to the beginnings of the internet, especially before, the World Wide Web was public, it was almost impossible. I remember when I was in the 7th grade trying to use the internet and I thought that AOL was the internet. I thought America Online and its portal was the internet, just not really understanding that there was a vast world of information, not as much as there is now, obviously. But that's what I try to tell my audience is we look at adoption curves and how fast blockchain is getting adopted faster than the internet. Funny enough, not as fast as the VCR. The VCR was the one that had the highest adoption curve out of all technology in the last 100 years. But, we know it happened to it. Hopefully not the same thing that happens to Bitcoin. But we're still so early on that adoption curve. There's time for people to get in and still be early adopters. That time is drawing short, though. Like eventually, this will be mainstream. Everybody will be using blockchain, whether they're using it or not using it. But back then, the difficulty in buying it and the tension between wanting to get in and actually getting in, like that was actually the sign of how early we truly were.
Yeah, and interesting. I didn't know that stat on the VCR, but that got adopted so fast. But hey, that was entertaining people. The idea of having movies at home, I guess people jumped on that real quick. But with this, it's still not that easy, to set up an account and get it all going. But it's a lot easier than it was. Do you see that the ability in the next 2 to 3 years is going to even get so that the average consumer would have no problem setting up accounts and buying Bitcoin and using it for trade?
2 to 3 years, I think, is a possible number. I mean, I tend to think maybe 5 years. I still think by the next Bitcoin cycle that we get, starting with the halving in 2024, I still think there will be some issues and some problems because when you think about Bitcoin, it's not like a straight bottom left to upper right chart. There are plenty of dips in that chart, and everybody knows the recent fall of Bitcoin. There was a fall back in 2018 of Bitcoin, and those times in what we call the bear markets, that's the times when there's a lot of stuff in innovation going on behind the scenes, but the average person loses interest. And I think that's got to factor in when we do have another bear market where the prices drop, an average of 85%, people get less interested. And, one interesting thing we do have rising up right now, though, is decentralized finance and NFTs. These are two niches within crypto that we don't really know how they're going to behave in a bear market because we haven't seen them in one. But generally, the mainstream is more attracted to those than other areas of crypto. Like, somebody that's out there just in the public, they don't care about supply chain tracking, but they might care about if they can stake and make money. So I think that's what we'll have to see. But I do think that one thing that is going to make it easier for people to buy crypto, but is also a terrible thing, is the banks getting involved. Yeah. The banks will be offering more and more crypto investing vehicles for people, whether I know Bank of America just recently had a story about how they're coming out with futures trading for their clients. And the banks are coming out with all this stuff, but yet on the other hand, they're still calling crypto frauds, crypto a fraud, which is kind of interesting. Like they're going to offer, futures trading in the future, but now you can't even get an approval from your debit card by Bank of America to buy crypto on some exchanges. So we constantly are seeing that tension as well between what banks are saying and then what they're actually doing and what they're allowing the little people to be able to do, the customers. But I think that is going to unfortunately be something that people are going to want. There was a recent report that said 80% of people would want to be able to move crypto into their bank. I think that's probably a fake number. I think it's actually probably less than that. But I do know I used to do a street series where I would go out and talk to people about Bitcoin. And I talked to a guy one time and he said, if it's not my bank, I'm not going to do it, period. So there is a large amount of people out there that want that convenience, even if it's not the best thing for the movement of decentralization and crypto and blockchain. Unfortunately, people are going to want that. So that's kind of how I see that shaping out over the next, few years.
The banks are the reason why we need things like Bitcoin. I mean, exactly. I mean, it's people like to describe the banksters. I mean, the manipulation of our monetary systems and the interaction between the Fed, the government, the central banks, all this stuff. The whole point is a decentralized, democratized currency, right? So I hope that doesn't happen, but I guess we'll see. You seem to be very focused in Bitcoin, particularly. How do you think that people should consider Bitcoin versus other currencies, cryptocurrencies?
Yeah. So I would say that behind me, I have a Bitcoin coin, a silver coin. I got a sign, and then I have a Bitcoin astronaut back here. But what I would tell you is I'm actually like not considered a Bitcoin maximalist by any stretch of the imagination. I hold more Bitcoin than any other coin, but that's because I use it kind of as a hedge because we do very well here financially, a hedge against the rest of the crypto market. I made most of my money through altcoins. So Ethereum, Cardano, Binance Coin, these are projects that we've all done well that, we may or may not talk about in this interview, but I love altcoins. I think that's the way that you get more Bitcoin. Ethereum specifically, though, is becoming, an altcoin, just for definition, for anyone who's watching here, an altcoin is any coin other than Bitcoin. I think we're going to have a special classification, though, because I actually believe that Ethereum itself is now getting on its own tier. I think we're going to see Bitcoin, Ethereum, and then altcoins. And as they prove themselves, they may move up into that top level. So Bitcoin obviously dominates the market. We actually saw Bitcoin dominance drop to about 39% this year. In the last bull run, we saw it drop all the way down to 32%. I think eventually it will drop into the 20s because there's just more competition. There's more coins. And so many people feel like they missed out on Bitcoin. If you look at the price of Bitcoin ranging anywhere, this year from, $30,000 all the way to $64,000, the average person lives paycheck to paycheck in America. So the average person can't buy a full Bitcoin. And, to process the idea that you can buy a quarter of a Bitcoin or a tenth of a Bitcoin is a lot easier for retail investors to just look at altcoins like XRP that's between 50 cents and $1, or Ethereum that's somewhere around $2,000 to $4,000 depending on what's going on this year at what time. That's a much more affordable thing for people to look at. And the new investor doesn't really understand what we call tokenomics, which is that actually the price is just derived by dividing the total market cap by the number of coins. That's how you get the price. Just because Dogecoin is sitting around 20 cents, that doesn't mean it's got the potential to go to $10 because it's got a lot more coins than Bitcoin. Bitcoin has 18.7 million circulating right now, 21 million ever. Ethereum right now has about 120 million. That number is actually supposed to decrease once what we call the London hard fork comes into Ethereum this year. But, just to kind of get back to your basic question, how should people look at Bitcoin compared to other coins? We just got to know Bitcoin's the first mover. It's the most secure, largest network in crypto. It's got the biggest market cap. It's got a lot of stuff about it we really love. People look at it as digital gold. That's the way I've been viewing it for years now. I've been putting out videos on my channel about that topic. I don't believe Bitcoin is going to be a currency. You look at El Salvador and Paraguay starting to adopt Bitcoin as currency. I think the people that live there are going to come to realize over the next 5 years that it's actually not something they want to spend. The best thing about Bitcoin is that the price goes up. Bank of America put that out also in a report. So I think if you look at Bitcoin as digital gold and you figure like, okay, well, what is the top for Bitcoin? A lot of people point to the market cap of gold and say it's $10 trillion. So Bitcoin can get to 10 trillion. Some people look and say, well, Bitcoin's a little more, adaptable. It's programmable money. There's a lot of cool stuff about it. Okay, let's say it can double that. Let's say it can get to $20 trillion in market cap, which would put Bitcoin, above $1 million a coin, I believe, so somewhere thereabouts. Well, if that's the case, then, what more can the rest of the coins offer? Bitcoin digital gold, a hedgeable asset. Ethereum offers an entire decentralized internet. It's called a smart contract platform. So I think if you look at the derivatives market in the world, which is $2 quadrillion by estimates, the rest of all of the money in the world, 500 trillion, $1 quadrillion, 60% of all of our money in the world is basically IOUs and derivatives. When you think about Ethereum having the ability to bring a lot of that market through synthetic assets into the and put it in regular retail investors' hands, I think that number is well above $20 trillion for Ethereum. I think it actually eventually will pass Bitcoin.
And I guess this is kind of an important distinction because a lot of the altcoins have functionality, like you just described, like with Ethereum. Do they get paid for that functionality, or is it, how does the functionality create value in the coin itself?
Well, I think Michael Saylor said it best. I did an interview with Michael Saylor, the CEO of MicroStrategy. Big Bitcoin bull has came in full force. I think he's like the number 2 Bitcoin holder behind Grayscale at this point, at least from a corporate perspective. Owns over 100,000 Bitcoin. Just got into it this year, or late last year in 2020. And what he said is this. He said, when you're investing in Bitcoin, you're investing in the apex, asset in human history, right? It was designed to be the perfect money. Unfortunately, it's now like the perfect gold. It's more actually like a commodity in a lot of our opinions. Ethereum and all the other projects, it's basically venture capital projects. It's kind of like investing into a company that's decentralized. So when the overall use of a coin goes up, the more people get into it, the better their market cap gets, the more rewards for all the people that are invested in it. So if you look at Ethereum, for instance, like here's a great way to put it in perspective. If you look at Ethereum and how much the network gets used, when the network gets used a lot, the gas fees to send a transaction goes up. And what does that do? That means the miners who are mining those transactions, they make a lot more money. Why? Because the network is getting used. And you can kind of look at a lot of different examples over the crypto landscape and see how that works. If you take Binance Coin, for instance, Binance Coin has the utility of, if you own a lot of Binance Coin and you use Binance.com, you actually get a discount on your trading fees. So you get paid, you get your trading fees back basically just by holding the coin. And the more people that hold coins, the less circulate, the less they're traded. And then supply and demand dictates that would also make the cost go up. So you can kind of look at every coin. And that's why it's important to understand the tokenomics of what you're investing in and understand how use can actually equate to a higher price. Because I would argue if you look at Bitcoin and you look at the number of transactions, there's not a connection between people using Bitcoin and the price going up. That's the narrative you hear, right? Oh, these countries adopt Bitcoin and the price will go up. Well, it's not necessarily true. Companies adopt Bitcoin and people actually are spending a lot of Bitcoin and people are seeing value in holding them, then there will actually be a tension there. So I think the Bitcoin as a currency narrative, I think we'll see it kind of destroyed in the next 4 to 5 years, and it will really take be cemented as digital gold. So that's kind of the relationship I see. Each coin is individually has different things about it that make it more enticing for holders to hold the coin and not to sell it. And ultimately the price, it's always going to be based on what someone's willing to buy it for and what someone's willing to sell it for.
So it's interesting, so the idea of digital gold, so it's just basically stored value, right? It's just a place to take and store value. And looking at what's going on, we can expect, I think, a good bit of inflation. The dollar inflating quite a bit. So that's you don't want to be in cash. You want to be in something like gold or digital gold. But now, if it's not going to be used as a currency, and the alt tokens, I think most of them are utility tokens, as you described. They have a functionality. Is there going to be any type of a cryptocurrency that's going to be used, do you think, that people are going to buy and trade goods and services with?
Yeah, so I kind of see this unfolding in kind of a two-way model, where at first we will have a crypto that kind of gets declared like this is the one. Who knows what it'll be? Bitcoin Cash, XRP, I don't really know. But I think we will see a crypto become kind of a global payments network to help with, especially with cross-border transactions. That's where XRP is, really strong. Stellar, XLM, Stellar Lumens, also very strong. Started by the same guy who co-founded Ripple Labs, which created XRP. I think that we're going to see something global. It might be a stable coin like USDC. That's another one that there's a lot of backing behind that, a lot of moving parts. Could become the digital dollar. We could have the digital dollar become the global payments network. But what's coming down the pipeline eventually is a CBDC. So that stands for Centralized Bank Digital Currency. China has been working on theirs. It's called the digital yuan, obviously after their currency, but the digital version, just like we say digital dollar. They've been rolling out tests. The reports back from the tests have been horrible. Everybody hates it. So what is China going to do? They're going to force people to use it. So they actually did a lottery where they recently handed out $30 in digital yuan, the equivalent of that. to people all over the country, trying to get them to use it. They added it into, I think they added into WeChat, or at least there was a beta version of that in China. So we are going to see eventually a CBDC, which is a digital currency controlled by the central bank of a country. I think eventually we're moving towards a one world money, right? A one world dollar, to where everybody's using a CBDC and all the centralized banks are working together. So kind of a grim picture for the future, if you think about it, unfortunately. But that is the technology. And this has kind of been going on. You go back, I don't know if you've seen the Economist story from, I think it was the 80s, where they were talking about the one world currency that they wanted to create. It was called the Phoenix, I believe. And they've been working towards that push. The banks have ever since. Now they have the technology to do it. So we're kind of caught in the middle of this, like, kind of a apocalyptic dystopian world that could be coming in the future with a great reset, them trying, the IMF and the World Economic Forum trying to make it to where we own nothing. We have BlackRock, the largest hedge fund in the world, buying up houses all over the world, especially here in the United States, 25 to 40% above their value. Why are they doing that? Is it to move people around, to move votes around? No, they're doing it because the World Economic Forum put out the Great Reset article, which said they want people to own nothing. They want us to have a complete sharing economy where all of the assets are in the hands of the very fewest people. And BlackRock is trying to buy houses because they don't want you to own a house in the future. That's why they're offering so much. They know how much more valuable it is to own everything. And that's what they're trying to do. In the future, you might sell a house and it might be a mistake because you may not be able to get a new one. So that's kind of the dystopian, apocalyptic, place we could be going, and blockchain will be playing a role in that. But I also believe the decentralization of blockchain is our only possible way to avoid that future. So that's something we talk a lot about on my channel, is being financially aware of what's happening in the larger context of the world, and the role that Bitcoin and Ethereum and a decentralized internet plays in that. It just matters on, how much we fight back against kind of the traditional systems.
Yeah, it is kind of interesting how it's, the battle lines are getting drawn, and it's really almost very much a spiritual and philosophical battle as much as it is a monetary battle, right? It's, the hearts and minds and how people are going to exist, on this planet. Because to me, and maybe I'm missing something, but having a central bank or government issued cryptocurrency is no different than the currency they're currently using, except it's digital instead of, piece of paper. Am I right about that?
Well, not exactly, because one, they actually have to pay for it to get printed. The other, they just hit a button.
Okay. Yeah.
It's actually much easier for them to inflate things. But I know you were talking about inflation, and that's something that we've really talked a lot about on my channel. It makes sense. I'm kind of hearing now there's another idea rising up, which is we could actually be heading to deflation, and that could be done through a digital dollar, where basically they just change the game. The Fed just changes the game, and they dictate how much each dollar is worth. And, if you look at Japan's been in a deflationary period for about 30 years. Our last one, I believe, was, kind of in between World War I and the Great Depression, which kind of ended it. So if you think about this, like you have Wells Fargo right now, they just cut personal credit lines to people. You're starting to see a lot of banks not be as, free with giving money out. Okay. Why would they be doing that? Well, because they want to hold on to the money. Everybody's wanting to get out of the dollar right now. We all look at the money supply. It is insane. There's no way to just fix it, right? Unless you hold all the cards. And the central bank system around the world, which has a very few people to own all of those banks together, you start doing the math, you start figuring out, they actually do control things. So if you look at how the bond market plays into all that, we could be seeing something different than what we're all expecting. We're all expecting inflation right now. When I can tell you this, when the average person on the street knows what inflation is and understands it, that could mean we're kind of at the top. You know what I mean? Like nobody's talking about inflation 5 years ago. Nobody's talking about inflation 10 years ago. Anyone you talk to now, oh yeah, the inflation is way up. Like it cost me so much to go buy some milk at the store. And usually that's when the financial cartel changes the game. So that's something to kind of watch out for. The digital dollar global payment network, that's how they could kind of change the game. If the digital dollar were to now become the reserve currency of the world, okay, We know the US dollar, the fiat currency right now is the world reserve currency. A lot of people think it's going to be China. But until we get to this place of this one world currency, and we had a global payment network that was built on a digital dollar, whether it was from a private or a public company, whether it was from the government or from a private company like, Circle with USDC or Coinbase with USDC, if that becomes the world reserve currency and it's digital, think about how much that could actually strengthen the dollar instead of crushing it. So that's something to keep in mind. This is things I'm hearing from high-level people that are talking about it. Everybody's thinking inflation right now, but deflation could actually be coming. It's the only way to make the money in the bank's hands worth more right now.
And that becomes kind of the challenge. I mean, we see the debt is increasing so significantly, and the way that they usually try to solve that problem is through inflation, right? That they're paying it back with dollars less than the ones that they borrowed. But at the same time, I think what you're saying is also a potential direction. So it's kind of like who knows in what. I guess we're also a bit in the serenity prayer, right? We nothing we can really do about this except to try to figure out how to put money in places that can hedge against those types of bad things happening. So one of the things you talked about was a Bitcoin cycle. Can you just quickly explain what that is?
Yeah. So Bitcoin cycles are, to me, the most fundamental thing you need to understand if you're investing in Bitcoin. Okay. Bitcoin is somewhat predictable. You see it on the news. If you're newer to crypto, you see prices going up and dropping, and you see news stories and narratives. But Bitcoin's actually been pretty predictable since the beginning of its time. And what this is based on is something called the Bitcoin halving. It occurs every 4 years, which sets Bitcoin on a 4-year cycle. Now, right now, we are actually in the 4th Bitcoin cycle. We've had 3 halvings so far. So let me explain first what those halvings are. You probably heard of Bitcoin mining. It's been all in the news, environmental stuff, not really as bad as they say it is, but that's a whole nother story. But Bitcoin mining produces Bitcoin by solving complicated math problems. That's the easiest way to think about it. A computer designed to do that solves a problem. When it solves a problem, it sends a transaction, gets a reward back. Okay. It started out with 50 Bitcoin per block mined. In 2012, that got cut in half. That's why we call it the halving. Literally cuts those rewards in half. So in 2012, it was 25. In 2016, it cut down to 12.5. And in May of 2020, it cut down to 6.25 Bitcoin per block. Now, it's a little hard to visualize. I find it's easier to think about the average amount of Bitcoin that's mined in a day. And that kind of puts it into perspective. Right now, we're having about 900 new Bitcoin mined per day. In 2024, after the halving we have then, we will only have 450 Bitcoin mined per day. And you can see that compound effect of the prices going up as the production is cut in half. If you're coming from traditional markets, you look at oil, right? Oil is a very easy example. If they just cut production a little bit, the price spikes. Imagine cutting it 50% every 4 years. My very favorite stat in Bitcoin, I talk about this a good bit. My very favorite statistic is that right now, in 12 years, Bitcoin was created in 2009. In 12 years, we've had 18.7 million Bitcoin mined, okay? Over the next 119 years, so by 2140, when the Bitcoin cycles end and all the Bitcoin are mined, there's only an additional 2.3 million. 12 years, 18.7 million mined. Because of the halving and the cut of production, over the next 119 years, only 2.3 million left to be mined. During the last Bitcoin cycle, there will only be 1/2 of 1 Bitcoin mined in 4 years. So the compound effect of it, the supply and demand that was built into the functionality of Bitcoin is what drives the price. So what happens is every 4 years when we get this Bitcoin halving, there's a supply shock because all of a sudden the Bitcoin miners that were, making all this money, now they've got to sell a lot of their Bitcoin because now they're only getting half back in return. And then all of a sudden the hash rate starts going up. There's more competition because the amount of Bitcoin you get per block is lower. So it's like a nuclear arms race to try to make sure that you can be in the best position to mine the most Bitcoin. So this halving effect, the cut in production, that is what makes the price of Bitcoin go up. So if you look back at all of the Bitcoin cycles we've had so far, once that halving occurs, that is the jump off. May of 2020. So if you think about Bitcoin, if you remember what was going on in 2020, beginning of the year, nobody was talking about Bitcoin. Nobody cared. We had the pandemic crash in March. Everybody thought Bitcoin was dead. Everybody thought stock market was dead. Everybody thought everything was dead. And then we have the halving in May. You have a little bit of lull. It's not automatic. It doesn't happen the day of the halving. The price will run up until the day. And then people are like, oh, what happened? The price didn't go up the day after. You have about a 3-month lull, and then things really start spiking. And that's what we see consistently time after time. And people will say like, oh, the cycles are over. They're getting longer. They're doing this. They're doing that. All that people need to know about these 4-year cycles, you cut production 50%, it's going to be worth a lot more now that only half as much are being created over this 4 years as the previous 4 years.
Yeah, this is the whole concept of a finite resource, right? And that's why if you got a dollar that's based on a gold standard, that's there's a relationship between these two things. But when you can just say, oh, if we just want to print more, I mean, that is completely erratic, and it's not a finite resource, which means its value goes way down. And that was I think the genius of Bitcoin and Satoshi, right? It's just saying, hey, we're going to put it on this schedule. It's like gold. There's only a certain amount on the planet, and the more you mine, it's less of it, which means it becomes more scarce. So the dynamics of what economics should be seem to all be brought to bear with Bitcoin, which is, I think, what makes it brilliant. Now, somewhat, I'd love to get your views on this, because this has been, how can I put it? Well, not really entertaining as much as it's maybe disturbing, but it shows you some of the whims of the market. We look at Elon Musk, right? So he invests, he has his company buy $1.5 billion worth of Bitcoin, right? Which sent the prices up. And you think, wow, okay, Elon, futuristic kind of guy, and he's buying a bunch of Bitcoin, means something. And then he gets kind of erratic with weird cryptic tweets and this other stuff going on, which has an oppressive effect on it. So what's your read on those types of behaviors in this marketplace, and maybe Musk specifically?
Well, I call him the Musk rat. He's a dirty rat. Okay. He's a dirty rat for sure. We just found out, there was just a report put out that Elon Musk and Tesla asked the CCP, the Chinese Communist Party, to censor anti-Tesla social media posts in China. So I think that right there tells the story. This is a guy that understands attention. He understands influence. He understands staying in the spotlight. To him, staying in the spotlight is much more important than what he's doing to manipulate markets. And to me, that's what really kills me. You got people that are losing money hand over fist based on stuff he's talking about, the environmental FUD, fear, uncertainty, and doubt, as we call it, environmental FUD on Bitcoin, which that can be debunked by anyone in crypto in 5 minutes. Mm-hmm. But he does that, and people are getting hurt by that. But he doesn't care, because this man only cares about end goals. He only cares about his spotlight, and he only cares about end goals. As long as he gets into space and colonizes Mars, he does not care who gets hurt in the short term. You could not convince me that he doesn't understand his pull on this market. Now, I would tell you that from what I hear from people on the inside of the industry, people from the banking industry, people from the institutional side, that really Elon Musk is a front man for market manipulation. Is that really and truly, if you look at his tweets and when he's saying it, it's really camouflage and cover for other larger players, including China themselves, that were trying to manipulate the market down. So he gets the brunt of the blow and looks like, oh, this is the guy that did it. But in reality, could one tweet really send the market down, $200 billion? I don't know if a tweet has that much power. I don't know if Twitter has that much power. So you got to understand there's other factors into play. You can see he's clearly trying to manipulate the market, but there's more to it. There was more stuff going on behind the scenes on that. So I've never, talked about a person that I have less good things to say about than Elon Musk. He's the worst.
Wow. Do you make sense of the fact that he just invested $1.5 billion and then, did things that had an adverse effect on that investment? I mean, how does that make sense?
Well, what I'd say is this, is they invested $1.5 billion. How much money does he have today?
Yeah.
I mean, it's over 100 billion, correct?
Yeah.
I believe he was the richest man in the world. I think Bezos passed him again, but I think he's in like the $140 billion range. Like he's extremely high. A lot of that obviously tied to Tesla, but guess what? When Tesla invests, they have to fill out an SEC form and acknowledge that they just invested in Bitcoin. SpaceX not a public company. Elon Musk Personal Investments, not a public company. So we actually don't know what he's doing in the background, behind the scenes. And then, of course, we have all the stuff with Dogecoin as well. I've got a lot of crazy sources about stuff he's doing with Dogecoin and plans to do Dogecoin mining across the country. Sounded silly. If you would have told me this a year ago, I would have told you I was crazy. But there is a plan for him to do Dogecoin mining to be able to allow people that are doing selling off their extra solar energy they're not using and paying them in cash for a rate per hour, but then actually doing Dogecoin mining with that money with something that's appreciating that he literally controls the price on based on what he says. So we'll have to see what comes to play, what comes to fruition with that. But that's what I'm hearing he's working on. There's a large 200-page document where he's got every single county in the country mapped out by all their energy laws, by how they offer tax credits, how they offer subsidies. So that's something to watch. So we don't know. He's got a much bigger play. I know it's easy to look at that $1.5 billion to me or you and say, oh, that's a lot of money. Like, that's crazy. But this guy's got a lot more money than that. He's very diabolical. And so whatever he's doing in the background, he knows he's going to make a lot more money than that because, you know, they're not making any money selling cars.
Well, and this is kind of interesting because, and first of all, I found what you said very fascinating because there's probably, you know, more of a hidden story than the visible one that we see. I think you're right. But he also has a fiduciary responsibility in the public company. You know, he's made an investment and he sort of has this fiduciary responsibility to the people, you know, stockholders that, you know, seems like he's walking a, you know, kind of a fine line there as far as he crosses.
So does that surprise you? Yeah. Does that surprise you about Elon Musk?
Yeah. Well, no, he's kind of out there. I mean, he definitely.
He's a maverick.
He's
That's
a maverick.
what they say.
Exactly.
He's a maverick.
Yeah.
He's a dork.
Yeah. Well, okay. I think enough said on Elon. But so let's talk about now maybe a bit of the future. I love just how assertive you are in your opinions. You know, you obviously have been living this day by day, and I think that gives you the right to be able to speak to these things in the way that you do. So let's talk about the future now. You know, a lot of people talk about how speculative you know, this market is, and I think, you know, there's, you know, good reason for that. But you know, for people to talk about, okay, if you are an investor, what percentage of your portfolio should be in crypto versus everything else? You know, most people, you know, they're down like 10%, maybe 15%. What's your view? I mean, how aggressive should people be on this if they're saying, I've got a certain amount of money that I invest in, you know, whether it be the stock market, real estate, gold, silver, you name it. What's your view on how much of their investment should go into crypto?
100%, but not all at one time. Right. Like, that's the thing. It's hard for me to sit up here with a straight face and make an argument for gold. It's hard for me to make an argument for silver. It's hard for me to make an argument with the stock market. I do have a very small percentage of what I have in a portfolio on the stock market. I think I got less than $20,000 on there. I've got an 8-figure portfolio total. So that'll tell you what I think about the stock market. And, you know, one of the coins or one of the things I'm invested in there is Coinbase. So Coinbase and Peloton, because my wife loves that bike. But in all seriousness, like, I can only tell people, like, I'm not a financial advisor. People who watch my channel, they know that. I'm the furthest thing from it. Okay. But, you know, people that watch my channel know, you're going to get my real opinion, and I can't with a straight face tell you I think it's a great investment, you know, to put money in the stock market. Now, it's not a great investment to put 100% of your money in crypto when it's at the top. Like, that's not smart, okay? But I've made all of my money in crypto. Like, all of my money is in crypto. 98% of my net worth is in crypto. I bought a building and a house, so maybe it's more like 92% right now, okay? So for me to tell people to do something else, I'm not a financial advisor, right? You know what financial advisors will do? They will go behind your back, and and I know this for a fact because I know several of them. They're investing in crypto, they're getting educated in crypto, and they're telling their own people they're advising not to buy it. Why? Because it's risky. Because it's risky. Well, let me tell you, scared money don't make no money. Right. That's a phrase we say a lot on my channel. People that are scared to invest, you know what? You've been tricked by the financial cartel to believe that a 5% return in a year is great. You've been tricked into that. Do you know how many returns the hedge funds are making? Do you know how many trillions of dollars the financial cartel at the top, the big banks, are making? Meanwhile, they've trained you to accept 5% is a great investment. Well, guess what? It ain't. You can look at my portfolio and you'll know that 5%, that's not cutting it. If I made 5% a year, I would just go do something else. Yeah. That's pitiful to me. Yeah. So when we're in a bear market, when prices drop, and I believe this will be sometime during 2022 when we will bottom out, who knows, maybe Bitcoin might go down to $15,000 even. If you look back at many of the altcoins, they offered the best possible returns during a bear market when people are the most scared. If you're going to get in crypto, you got to have passion and you got to have conviction. If you don't have those two things to where you believe in blockchain technology, then I would tell you not to invest in it at all, because you're going to sell at the wrong time and you're going to lose all your money. But if you understand that in 100 years from now, there's a 0% chance we're going to be trading pieces of paper and pieces of metal, and it's shaped in a circle to do business, and you understand everything is going digital, then you know what's coming. You understand that's the future. There's no way 100 years from now we're trading paper. That's just not going to happen. That's not the way that the world is going. We'll probably all be in VR headsets all the time and living in the metaverse by then. I meanwhile will be cryogenically frozen. But the point here is that if you understand that passion and conviction to get into crypto and what the future is coming, then that's what gives you those great investment opportunities during the bear market. So I have almost 100% of my portfolio in crypto. It's been the greatest life-changing financial freeing thing that I've ever gone through. And I want that for my audience. I want that for anybody that's out there in the world. So I would say, look, it may sound, very risky, but almost 100% of mine is. Real estate investments, I would say, still can be a good place to put money. That's the other place. The other thing that I do have, like I said, it's a home, a building. I've got, 2 other houses that we bought over the last year, a little bit of property. So real estate is one place where you can look, because, they're not making any more land is the phrase people like to hear, right, or like to say. So I would say real estate and crypto. I mean, that's all I'm interested in.
So you talk about bear market. Are we in one now? I mean, Bitcoin's at its high was 60,000+. Now it's down around, as the time of this recording, we're right around 30,000. Do you? So you think that this is going to persist for a while, and do you see it going lower, or are you buying right now?
So when I say $15,000, I expect it to go up by the end of this year to $100,000 and then drop 85%. So percentage drops are kind of weird. I think 85% drop from 100,000 should be right at 15K. Makes sense. But somewhere between 12 and 20K, I think it'll drop back down to. But I think we have one more run up left. If you look back at the traditional Bitcoin cycles, there is a history to suggest that we're not done with this bull run yet. If you look right now at on-chain metrics for Bitcoin and Ethereum both, you see something very common. You see retail sellers getting out. You see the biggest whales, the biggest wallets accumulating. They only do that leading to run-ups, because why would you be accumulating at a price that if it's going to drop much lower than in the near future? And, crypto is it's more free than the regular markets. And the reason being is because it's all in open source ledgers. You can see every transaction on a blockchain. So, we're not living in a world of 100% manipulation, but there is a lot of manipulation on the markets, and the whales know what's coming. A lot of those largest Bitcoin and Ethereum addresses are actually institutions that hold those. And there was a really interesting story that came out a couple of weeks ago, which is since May, so since the crash in May to right now, a few months later, the biggest 20 Ethereum wallets gained 2% more Ethereum. The 20 biggest wallets hold over 20%, almost 21% of all the Ethereum that's out there. So your retail investors are scared they're selling. Your biggest holders are adding more during this time. We also have exchange reserves that are dropping tremendously. A lot of that due to Ethereum's upcoming EIP 1559 and their ETH 2.0 rollout here in a couple of years, where people are pulling Ethereum off exchanges to put it into validator nodes to where they can earn interest when they stake those. So they'll earn money on that. So when the exchange reserves are dropping, there's less circulating supply. And then when the whales are accumulating, that should be telling you that I firmly believe that we do have one more run up and we will set a new all-time high this year. However, by the end of this year and going into 2022, we will go into the part of the 4-year cycle that is the bear market. Now, a lot of people will tell you bear markets last forever. It's actually not true. When you look at the Bitcoin price over the years, for 75% of Bitcoin's life, it's going up. For 25% of the time, it's going down. The problem is For the 1 year that Bitcoin drops, it drops so tremendously that by the time it starts going up, you're still well below all-time highs and people still feel very bearish, even though you're making progress. So $20,000 in 2017 is what it hit. It dropped down to $3,000, $3,200, almost exactly 1 year later. And then it basically took, 2 years to get it back up to all-time highs, or almost 3 years actually to get it back up to all-time highs. So, that's traditionally what we see with the markets. And I believe we will see the same thing. It was funny a few weeks ago, not a few weeks ago, I guess about 3 months ago, I was on a different show. It was a great show. I really like being on it. But I was on with 5 other guests, and 4 out of those 5 people were saying, we'll never see another bear market. Bitcoin's going up forever. And then the next week we got a 55% drop. So, you just got to remember Bitcoin is volatile. That's why it's very important to pick your entry points wisely.
Well, this has been really informative and enthusiastic all at the same time. So I very much appreciate. Sometimes a lot of people can talk about this stuff, but they're kind of nerdy, and it's they don't have the emotion that goes with it to gain interest. So you have a passion around this that's just contagious, and I appreciate you taking the time to share all that with us today.
Absolutely. I'm a very proud non-nerd in crypto. There are a few of us. So definitely thanks for having me. It's been a blast.
Thank you. Well, that completes my interview with Ben Armstrong. Again, really excited that not only I could share him with you right now, but that my kids even knew who Ben Armstrong was. So it shows that he crosses generations with his information, and it was great for me to be here with you right now and have that conversation. Well, that completes just episode 1 of our 9-part docuseries, Money 2022. Thank you so much for being here. And right now, it's still a great time to share this with other people so that they can get in on it during the free viewing period. Sharing is definitely caring in this particular case. I look forward to seeing you in episode 2.
While the Federal Reserve over the last year has been trying to sell everyone that inflation isn't a problem, it actually is. I believe they knew it was coming. I believe this is exactly what they're looking to create. And it really leads to why I'm so excited about, what I'm calling the return to real. Because while the Great Devaluation was about a global monetary reset, where all currencies devalue, the return to real is what happens after that monetary reset.
The NFTs are just ways to show representation of ownership on the blockchain, and their popularity really came about when people started putting pictures behind it. I think there's a lot of fads going on in it, but I have learned not to ignore fads. So something will come out of all of this. For that very reason, I'm not selling my NFTs. There's just the beginning of this whole thing right now. There's more companies that are adopting this, and so what may have been a fad is turning into something very real.
People will always favor the money with the most inflexible supply, which is to say the medium most resistant to debasement or inflation. I think that's the real breakthrough moment for most people understanding the value proposition of Bitcoin versus something like gold. Its supply remains fixed. That's what gold was historically, and that's what Bitcoin has essentially perfected by being the first fixed supply asset in human history. Bitcoin is an invention, but I think it has actually led us to the discovery of absolute scarcity for money.